Welcome, this is Drew Blazsik, Logos Markets. We're going to talk about option trading in these videos. And what we're going to do, this is the introductory video. We're going to talk about what is a put and a call. And through that, we can go through different option strategies, how to protect ourselves during different downturns or economic booms, what we think the stock market's going to do. So let's look at first what we know about what a put and a call is. So what I'm going to do is we're going to go over the graph. And what we're going to do here is we want to think about what is a put and a call. So the first thing we're going to look at, what is a put? A put is a right to sell an underlying asset. We'll just say Apple stock. It's a contract. And it doesn't, so I want to sell it at a certain price. It doesn't mean I have to own it. It's just a contract to sell it. So it's a right to sell for a certain price. So what are we doing with a put? We're betting that the stock is going to go down. We're hedging our risk. We think it's going to go down. We think something might happen, or I'm going to protect myself just in case. So it's a right to sell. And what we have also is a call, and a call is a right to buy. And it's the same concept. It's a right to buy an underlying asset. We'll say something like Apple stock. Now, we want to know some important variables going forward. So we have the contract. Again, we only will sell it or purchase it if it benefits us. And it's real important. One is a right to sell, a right to buy, but you have a buyer and a seller of those contracts. So for example, a put, a right to sell, but you have a seller and a buyer of the contract, and you have a call, a right to buy, but you have a buyer and a seller. And what we say in this is that if we say long the stock or we long the contract, that means we are purchasing, and if we say short, we are selling. So that's important to see. A couple other variables want to know, what is the strike price for the contract? Right? I want to know the strike price, which means I can exercise my contract if it hits a certain price. When we're talking about a sell, that means if I think, and what we're going to do is we're going to say the underlying asset is $100 in all our examples, and we'll say, what if the stock price goes down? Well, if it goes down, the strike price could be 90, right? It could be 95. It could be 50. The closer it is to the stock, or if it's in the money, or if it's beyond the stock, we're talking about a put, the contract would cost more. And if it's a call, it could be a right to purchase at 110, 105. The closer it is to the stock price, or if it's in the money, if it's 95, it'll get more expensive for the contract. So we want to know what the strike price is. The strike price would tell the buyer of the contract they would exercise the contract and exercise. They'll go with the purchaser or sell it if it's going to hit the strike price. So it really depends on what that is. We also want to know, what is the premium? That's the cost, and we'll say in our example $3. That's the cost of the contract. It's important to see the buyer of the contract is going to cost them $3, and the seller is going to make $3 on this contract. So we got a strike price, we got the current stock price, and we have the premium. So through this, now we can draw our graph. So we're going to do a profit loss graph. And in all my courses, I always do this profit loss. That means anything that's beyond the x-axis here, it goes up. That's a positive amount. We're making money, and this is a negative. And then the y-axis, this represents the underlying asset, the stock price, the different price that it could be. So it can go from $100 is our example, and it can go all the way up to $1,000 and beyond that. So we'll say the current stock price is 100. And then it could go beyond that. So in this example, we're going to look at, what does a put look like? That's a right to sell. So we're going to draw that $100. That's the current stock price. Now we want to know, what is the strike price? Well, in this example, we're going to say the strike price is 90 in this example. So I'm going to draw a 90 here. That means if it hits 90, I could exercise this contract if I purchase the contract. I want you to think about, if the stock price is 100, why would you sell it for 90 if the stock is greater than that? You would be losing money. Now, if it went down to, let's say, 50, it had a 50% decrease, then you would exercise it. You would want to sell the stock for 90 then. So anything that's beyond the strike price is considered out of the money. And if it's at 90, that's at the money for the contract. And if it's less than 90, that's in the money. And remember, it always is dependent on the buyer if they believe they're going to make a profit off of it. Okay, so we have the stock price. So the stock price can go to whatever price. And what I want to do here is I'm going to show you the profit loss of the buyer and the seller. So I'm going to go, we'll do the buyer first. Anytime, it's really easy to think about. The buyer, if they purchase, they put, well, what is it going to cost them? It's going to cost them $3. That's the cost of it. So we want to look at, if it's out, we're the buyer of the contract. If it's out of the money, we are not exercising the contract. That means, what is our profit loss? Well, it costs us $3. So I'm just going to draw this line out of the money. That's a -3. So I'm going to say -$3. And this is the profit loss of the buyer. So right now they have -3s out of the money, right? If the stock is over the strike price, why would they sell it for more than what it is? Or why would they sell it for the 90? I would say for the contract. Why would they sell it 90 if the stock price is over that, beyond the strike price? So this is their profit loss. Once it hits the strike price, now the buyer can exercise the contract. And what's going to happen here is, as the stock goes below 90, let's say 89, now our profit loss is looking a little better, right? We paid 3, but if we sell for 90 and it's below that, we sell for 90 and let's say it's 89, that means we made $1 on that contract, but we're still -2 because it costs us 3. And then as it drops, now we're going to have something called the break even. So I'm going to call this the break even point is right here, and that's going to be at $87. So if the stock drops down to 87, that means the buyer, the put contract, sells it for 90, now it's at 87, and they make that difference, $3. However, it costs them $3. Therefore, they have a break-even point at 87. And if the stock keeps on going below that, our profits go up. And that's what the buyer's profit loss looks like on a put. Now let's look at what the seller looks like. So I'm going to change this color to, put it green. So the seller is going to look like, and it's real important to see, they're going to mirror the buyer. So if the buyer is down -3, that means the seller made $3, right? They sold the contract to the buyer. So right now they are making a little bit of money, and they're making what the contract sold for, $3, right? It's not going to be exercised because it wouldn't make sense for the buyer. If the stock price never drops below 90, they're just going to let it expire. They're just going to let it go, and that contract was really just an insurance plan, a protection just in case it did drop. So if the stock price keeps on dropping and we still have a profit loss, now it hits that strike price, and what's going to happen here is that if the stock goes below that, the strike price, now the seller has to pay the buyer that difference, and they have the exact same break-even point because they're going to mirror each other. So if the buyer made 0, that means the seller made 0. And then as it goes down the stock price, the seller of the contract will lose. So if the buyer made $10, the seller loses $10. So that's what a put contract would look like with the buyer and the seller. All right, now let's look at what a call would look like. So I'm going to draw this again, our profit loss, and this is going to be a call, which is a right to buy an underlying asset for a certain price. We have to know the premium. The premium in our example is going to be 3. The current stock price is going to be the 100, just like we did before. And then we want to know what is the strike price. And the strike price in this example, we'll say is 110. Excuse if it looks sloppy. I'm trying to draw in Excel, a little different there. So all we're going to do is we're going to plot off. This is the current stock price, 100. We have a strike price right here, and that's going to be the 110. That means if it hits 110, the contract states if it hits 110, we have a right to buy it at 110. If it goes to 120, I could buy it for 110. If it goes to $1,000, I could buy it for 110. That's important to see there. And then, so what we want to do is here, now we're going to look at the perspective of the call. Let's look at the buyer first. So I'm going to draw the buyer. So again, what did it cost the buyer? Well, it cost the buyer, which is the premium. That's the -3. So I'm going to draw -3. And this is what the profit loss is going to look like in a call. That means if it is less than the strike price for a call, so we're looking at this side, that's out of the money. If it's less than that, if it's greater than 110, it's in the money. And if it's at 110, it's at the money. If it's right at the 110. So if we're out of the money, what's going on here is we have a contract to right to buy. Well, it wouldn't make sense. If the stock price is $50, why would I buy it for 110? That you would have a massive loss. So the buyer's just going to let it expire. So the buyer's just going to be down the -$3. So it's their profit loss. Once it hits that strike price, and if the stock goes up, let's say to 113, that's going to be our break even point. If it hits 113, which means they're going to buy it at 110 and the stock is worth 113, and they made a zero profit because it cost them $3. They made $3 on the stock and it cost them $3. And then if it goes up to, let's say, 115, we made $2. If it goes to 120, we made $7. So as the stock keeps on going up, we make more profits. And for example, if the stock did hit the 120, right, if it hit 120, that means this would be a profit loss of $7 because we could buy it for 113. That's the break. I'm sorry, we could buy it for 110. The break even's 113. So technically, we bought the stock at 110 is 120. We made $10 minus 3, and that's where the profit loss of 7. So now if we look at the perspective of the seller, well, the seller, if it's out of the money, is going to be a +3. And again, it's going to mirror it. It's going to be a +3. There's the strike price. It's going to mirror it. They're going to have the exact same break-even point, and then it's going to go down from there. So that's going to be the graph for a call option. A couple notes I want to make before I show you the Excel equations, and we're going to use that in the next videos. A couple things I want to mention is there's a European option and an American option. A European option is something where we have to wait to the expiration date. So these options could expire in 3 months. The longer the contract is, the more it's going to cost me, right? The closer it is to the stock price, it's going to cost me more for the contract. If it's a call option and I have a right to buy it for $1 million, it's going to be very cheap because no chance it'll hit $1 million. But if it did go to 2 million, I could buy for $1 million. How it works. So the European one will expire at expiration date, which means I can exercise it at the expiration date. The American contract can do it at any time, which makes it much more difficult to price these contracts. I just want to make a note there. Let's go at the top of this Excel sheet here. And here are the formulas. I'm going to kind of briefly talk about why when we do it in Excel, why we have to do it this way. I want you to think about it. So we have a call if we buy or long. This is the formula. And then we got a put if we want to long. We want to purchase a sell, put option that we have a right to sell. Both of those have a max function, and I'm going to explain why. Let's do the call first. The call is going to be one of the profit loss in Excel. Well, first off, look what we have here. We have a negative call premium to buy, right? So whatever the premium is, we want to subtract it because if we're buying the contract, it's going to be a negative. And look what we're doing here. So we're looking at, now think about the call. It's going to be, our profit loss is going to be, if the stock goes at 200, well, I have a right to buy it for 110. So my profit loss would be the stock price minus the strike price for a call, right? And the reason why we did a max function is because if the stock price was at $50 and the strike price of 110, I wouldn't exercise the contract for 50 because then it would be 110, it'd be 50 minus the 110. The stock price is at 50, strike price at 110. That would be a negative. So what we're doing here is I want the max, whatever is greater. The stock price minus the strike price, and I'm only going to exercise if that's a positive amount, and then I'm going to hit a comma and say 0. So for example, if the stock price is 50 and the strike price is 110, that's negative 60. Well, I'm going to let it expire, and this max function would not pick the negative number, it will pick the 0, right? Whatever is greater. In other words, if it's a positive amount, that's a profit gained. I want that amount calculated. If it's a negative, I'm just going to let it expire, and it's going to be a 0, and then we have negative premium. So that's the basis, that's the rationale behind how we're going to do these functions. And I'm not going to do the sell, we'll do that in our next videos. But I do want to bring your attention to the put and make sure it makes sense. So anytime you buy these, it's a max function. If you sell it, if you notice, it's a minimum function. If you notice, if it's a sell, we are positive on the premium because we're getting the money. And if it's a buy, we're a negative. So real quick on the put, I want you to think about, if you bought the put, what is your profit loss? Well, your profit loss is going to be the strike price, right? I could sell for 90, and if the stock goes below that, let's say 50, I sell for 90, and the stock is 50, so I make 40. So it's going to be the strike price minus the stock price. It makes sense, right? Now, if the strike price is less than the stock price, which means the stock price is at 200, strike price is at 90, I don't want to exercise it, so I want whatever is greater. 0 or a negative number, I'm going to let it expire, and I want the 0. If this is a positive amount, that's why I want the max function, so you have a good idea. There you go. So that's the basis of or the introduction of a put and call. The next video is I'm going to do a video on a put and a call. We're going to do that strategy in Excel through the sim method. So it's going to light up green if you get it correct, and you're going to see how it works. And then we're going to start doing option strategies. So if you learn how to do the put and the call, you will learn how to do all these different option strategies. So we'll read how to do that. We have to purchase a put or sell a call. We'll do all these different, really crazy different kind of different combinations of these puts and calls, and we'll see how the strategy works. So I'll see you in the next video. This is Drew Blazsik with Logos and Markets.